Hello, good morning everyone. My name is Dwi Ruth Kurniasih, or in short you can call me Ruth. And in this opportunity, I would be like to sharing to you about my mind mapping video as the summary of corporate finance course lectured by Prof.Ir Sembel at IPMI International Business School. This course was divided into 8 parts, from the introduction to financial management until the event analysis and portfolio evaluations. Let's begin with the first part of the course. In the first part of the course, we were talking about the financial management. I would like to jump a bit about the financial management, that the goal is divided into 4 items. Basic, which is like profit and wealth; operational, which is like timely, effectiveness; and then social, and also research. And also, second part about the financial management is the importance of numbers, which is going to be related into the principal agent problem and GCG, or good corporate governance. The principal agent problem will consist of conflict of interest, asymmetric information, and moral hazard. And the third part of the financial management is about the cornerstone, which is provided into 4 parts, which value is driven, cannot create value, expectations treadmill, or in other case it's like a shareholder and fundamental performance, and also the base owner, who owns and or manage the business. The second part is talking about the value. And when we are talking about value or the sources of value, it is divided into tangible and intangible value. Tangible is something like physical and financial. Intangible is like employee and supplier, customer, organization, and reputation. And then the second part, we are talking about the process of value. It is from the customer to the shareholders, starting from the product offerings to customers that produce positive return, and it must be preserved from the inefficiency and poor management. And to manage it, we have to take the balance scorecard into the considerations, which is consists of financial, customer, internal business process, learning, and growth. And these 3 items will related to the ESG, or the environmental, social, and governance proposition, that will link to the value creations in 5 essential ways as mentioned by McKinsey and Company. It's going to be related to our top line growth, cost reductions, regulatory and legal interventions, productivity uplift, and investment and asset optimizations, which are the examples that you might want to check at the screen. The third part is we were talking about the investment portfolio and its advantages. And in this part of the course, we were given a task to evaluate the financial performance ratio of a company. And when we are talking about the investment strategy, we have to understand the framework of analysis. It consists of the fundamental values, intrinsic value versus the market price, and the fundamental indicator. And these are things that we need to take into considerations. For example, fundamental is consists from the balance sheet, income statement, and cash flow statement. And fundamental indicator, I think it's quite usual when we are going to analyze the financial ratio of a company report. We are going to calculate the profitability, liquidity, activity, leverage, and market price as well. The next part, we are going to talk about the capital budgeting and the capital structure. Starting from the capital budgeting. Capital budgeting purpose is to estimate expected future cash flows, evaluate the project based on capital budgeting evaluation criteria, decide whether which project is good or bad. 2 or more projects can be mutually exclusive. If it is mutually exclusive, we may choose only one. If it is independent, we may choose all good projects. And the future cash flows, we also divide it into 3 types, which is the initial outlay, operating cash flows or differentials, and the terminal cash flows. It is provided into this picture, some kind of a timeline. And the second part, we are going to talk about the capital structure. So capital structure is actually consists of 2 items, which is fixed assets. So fixed assets consist of debt, preferred, and shareholders' equity. And when we are talking about this capital structure, we need to also understand the theory provided by M&M or Modigliani and Miller. And we have to always take the integration of tax effects and financial distress costs into the considerations, as we might want to see from this graph. Going up is about the value of firm, and then the horizontal part is about of the debt. And when we are going to take the linear part of it, we have to understand the maximum firm value, we have to also understand the present value of tax, and we have to also understand the value of firm under the with corporate taxes and debt. And this is also the calculation formula about the CIIM, or the capital asset productivity measurement. The next part, we are going to talk about the process integral financial distress. So when we are talking about the performance at different stages, we have to understand these are 7 steps of the seven stages of the performances differences, from the early impairment to the deteriorations of performance, to the cash flow problems, to the failure, default, insolvency, and unfortunately, last but not least, is the bankruptcy. And this is something that every corporate and every financial staff in the corporate needs to always train or to always exercise with, because this is a financial distress. And the financial state of the corporate financial distress coming from the solvent, it's quite normal. Medium part is distress, but solvent, it's medium. And the hardest part is when it is insolvent. So that's why this part always must be exercised, especially in the top level management. And BCG, or the Boston Consulting Group, also provided us a measurement about the growth share matrix. So it is divided into 4 windows, and they analogy it into 2 different animals. Dogs is when the market share is low and the market growth is low. Cash cows is when the market share is high but the market growth is low. And then the bottom left is the question mark. It is when the market share is low but the market growth is high. And the bottom right is icon with stars. It's both high of the market share and the market growth. The next one, we were talking about the financial shenanigans. So there are 7 parts of financial shenanigans that we need to understand. Number 1 is when it is recording revenue too soon. For example, shipping goods before sale is finalized, recording revenue when important uncertainties exist, and recording revenue when future services are still due. Second is the recording bogus revenue, recording income in exchange for similar assets, recording refunds from suppliers as revenue, using bogus estimates as interim financial income. Third part is about the boosting income with one-time gains, when boosting profits by selling undervalued assets, boosting profits by retiring debt, failing to segregate non-securing activities. Fourth part is the shifting current expenses to a later or to an earlier period. So for example, it's like the improperly capitalizing costs, depreciating or amortizing costs too slowly, and failing to write off worthless assets. The next part is about the failing to disclose all liabilities. Reporting revenue when cash is received in advance of providing services, failing to accrue expected or contingent liabilities, failing to disclose all materials commitments and contingencies, and engaging in transactions to keep debt off books. Sixth part is about the shifting current income to a later period. So it's like about creating reserve and releasing them into income into a later period. And last but not least, shifting future expenses into the current period, like accelerating discretionary into current period, writing off future years, depreciation, and amortizations during the current year. So this financial shenanigans is something that we really need to take into considerations and we need to be always aware of. And our lecturer also suggested us a book written by Howard M. Shillett about the financial shenanigans. coming to the final course, we were talking about dividend. So practically, there are 4 items that we understand it from the dividend. So it's about how much of the firm's earnings should be distributed to shareholders as dividend, how much should be retained for capital investment, and if we retain earnings for profitable investments, so then the dividend yield will be 0, but the stock price will increase, which will result in a higher capital gain. But if we are taking it the other way, if we pay dividends, stockholders receive an immediate cash reward for investing. But the capital gain will obviously decrease since the cash is not in the firm. In the final part of the course, we are talking about the market efficiency. So market efficiency will consist of prices reflect all available informations, weak, semi-strong, and strong, random walk, just like what the analysts done, and strategy. So the strategy that being suggested is to diversify. Don't try to time security price movement. Keep tax consideration in mind. And last but not least, take passive investing into consideration. For example, index fund or dollar cost averaging. And there is a good quote provided by William F. Sharpe, our great godfather and the Nobel Prize recipient in economic sciences. And I think that's all 8 parts of the courses about corporate finance provided into several different mind mapping slides, and thank you very much for your attention.